Good weekend, all. Ira Epstein with your financial market wrap-up, and this wrap-up is your weekend edition, and we're about 4:30 in the afternoon on Friday, and this is the 9th of September, 2022. 12 days. Keeps going through my mind. 12 days. Not Christmas, by the way. 12 days to the FOMC meeting when we find out the next interest rate move. Well, we know it's going to be an increase. The question is how much. That means that I've got to be concerned about this Tuesday. Tuesday morning, we get the CPI number. This rally that we've gotten over the past 48 hours, that has been a powerful rally, I think it was a rejection, and I've said this to you each day here. I think that what the market did is ran out of the Jackson Hole steam to the downside, and the market's looking over its shoulder and saying, you know, gasoline prices are down 87 days in a row. Did you hear what I just said? 87 days. I'm also looking at food prices. They're not up as much. Aren't they a little cheaper? That guy from Kroger on today on TV on the earnings report talking about how they increased their forward guidance. Food prices came down a little bit. All their deals with coupons and gasoline rebates working like a charm. They're picking up people. Okay. So I think the odds are pretty strong that the headline inflation number is going to be not a surprise, but down. Now, is it going to be down a half a point, a full percentage point? Could be. Could be bigger. I'm guessing on that. The problem is the Fed looks at that but doesn't really base its ideas off of that. They tell you that all the time. Their preferred measure, keyword preferred, is core CPI, which does not look at food and energy. Have you seen anything in those items really falling very sharp? That is my point. So I think we're in for a left swing and then a right swing. First thing, I think we're discounting the favorable headline CPI. So if the market discounts it going into the report, you get what you thought, doesn't able to run with it. The other thing the market will look at is once it sees the report and dissects it and takes a look at core CPI, I'm either right or wrong. If it's real sticky, the pros will understand, that's what the Fed's going to look at. And come now 10 days from then, the market will be saying, the Fed's going to still stay very aggressive and the words could be quite hawkish. That's what I'm expecting. So we came down. You take a look at the charts with me. We came back and challenged the close of the Jackson Hole meeting. And after the Fed spoke, the market came down. So let's go there. First thing, on the monthly chart, ever since you got under this time frame at the beginning of the year, you really haven't gone anywhere all time. You stayed under it with the downside bias on the bigger picture. If you and I step back, and I'd like to right here, and go back to Jackson Hole, this is the 26th. This is what the market looked like. It finished off 4% for the week, and you know what the Fed chair had done. Now, how many times do you want to discount the same piece of news? That becomes the importance. The week after, you fell another 3%. You then got your bounce this week. Here's my point. When we fell down to that, if you go and you look on YouTube, I said, I wouldn't be surprised if you start playing around at that 18-week average. That's what I think. I think from here, the market has to make a key decision. Either you don't go back and take out last week's low, and that low was on a closing basis 394.50, and the market decides to run into the next Fed meeting, or you take that out, and if you take it out this week, the Fed meeting, I think, just sends you lower. I think you have to look at that is the way to look at this chart. Right now, who's in control? Going home, the bias is with the bulls. The market's on the upside. When I come over and I look at the S&P chart on a weekly basis, without any studies on it, this is how we look. You have the swing lines with higher lows, higher highs. That is certainly bullish. No getting away from that, and it's been that way for quite a while. The market's fighting a battle at the 18-week average. Gee, I'm so surprised that I've told you that. That's what I expected. The resistance on this rally should be the 41.67 level. That is the 100-week average. It doesn't have to get there. It can just hang in right here as we trade a little bit more. The Bollinger Bands are the two extremes in the market. Obviously, if the bulls really want to run with this market, can you drive the market up another 250, 60 points in front of the FOMC meeting? I doubt it. So I think the more realistic tone of the market's 41.67 on the 100-day for the resistance. And in momentum on the slow stochastics, well, the market's gotten itself pretty neutral here. So when I go to the Dow, I don't have a pattern like that. Now, I want to come back to the pattern on the S&P before we do that. I wanted to show you the Dow. This is an outside week up. If you take out this week's low this week, I think you open the door up right away for a move back to 3,700. That's my guess. If you don't take that out, then the question is, can you get up to 41.67 or you just hang right here? Those are the questions you're going to deal with this week. You don't have that pattern in any of the other indices. They did not have outside weeks up. So they are right with their lows are right here. These are your points. You came down and you're fighting your battle at the 18-week there. You're fighting your battle in the NASDAQ right here. And notice where your Bollinger Bands are. Those are your two extreme points. Obviously, the NASDAQ is building resistance at the 100-week and the Bollinger Band very close together. And so is the Russell, actually. The Russell's got the 100 and not too far apart, 68 points. That's not an awful lot. This market fell to its 200-week and the 18-week and found its support there. Had it done this last week? No. The market didn't do that. It missed the 200. It grabbed some traction right there. But they do not have outside weeks up. Outside weeks are important. If you take out the low of an outside week within 2 weeks, it normally kills that continuation pattern. And yes, an outside week is often the first step continuation, so I'd expect higher highs to be coming out of the market. It's when you take it out that the market gets thrown into disarray because you've caught a group expecting one thing, they didn't get it, and that forces the market to go the other way. In the T-bond market, what are you caught in? You're caught in the top part of the upper Bollinger Band and lower band. Why trade that? When the market gets up to the upper band, I promise you, I am here saying that's where the pros are coming out of longs. I am telling you the pros are coming out of shorts, but what does that mean? They're coming out of shorts, it means the CPI is probably a friendly number. And the people will say, well, maybe the Fed doesn't have to push as far. That could be it. Maybe. Doesn't mean you can't get a breakout to the downside. I'm just giving you what to expect. Why gamble on that CPI report is what I'm saying. You have time right afterward, the weekly chart. That's only Tuesday. You got the rest of the week to take a look. You can come back in if that's what you thought you had to do. The same thing on the 10-year note. This is where people are the most bullish. This is where they're the most bearish. You do understand that. That's what happens. Do you stay out of those bands very often? No. Can you? Yes. The tighter the band gets, and when you break out, it's important. This is the tightest it's been, honestly, since the beginning of the year. So it's a relatively tight band. You have to pay attention to that. In the dollar index, where do you think I would tell you the resistance is? I'm going to tell you the pros are not buying the upper Bollinger Band. Now, could we embed? Embedding is when you take a market and you change the momentum because the slow stochastic for several days or more gets both the K and the D line. The red is the K, the D is the blue, and they both go sideways over 80. You have 2 weeks in a row. You have this week and last week where both numbers are what? Over 80. If I go one more week, it's not there. So this week, by the end of the week, determines, do we have that embedded reading going into the FOMC meeting? It's going to be very important. If it embeds, the dollar generally goes up if the Fed's going to keep raising interest rates. So just put that cap on your head. In the eurocurrency, this was an interesting week. First of all, are we embedding? Real important to me. Both numbers are under 20. Both numbers were under 20 the week before, and both numbers are under 20 3 weeks in a row. My work says that unless the red number closes over 21, the pros are going to take this opportunity of the rally and sell into it, looking for the euro to break even further. The exact opposite of what the market did today. We'll see if that is in fact the case. If you get a reading over 21, then I think you're going up to the 103.33 or wherever that 18-week average is. In the Canadian dollar, it's void of a trend. You have a higher high, a lower low. The market has paid attention to the lower Bollinger Band each time you've hit it, and to the upper. I think you'd agree with that. It stayed pretty much within them. In the Japanese yen, you are probing the downside of the market. Now, you're nowhere near embedding. You've heard the Japanese government begin to say they're looking at FX rates. It's a warning sign that they may say, okay, maybe this, 40-year low or whatever the number is low enough for them. I don't know. Here's what my work would say on a weekly basis. I don't stay short against Bollinger Bands if you're not embedded. That's what I teach in my courses. That's what I'd be saying. Bitcoin, nice rally today with the general stock market. The bigger picture is you're taking the black lines, the Bollinger Bands, and you're wrapping them around price. Here too, do we have anything that's embedded? Well, both numbers were under 20. I think you'd agree with that. Both numbers on the week of the 9th were under 20, but they weren't the week before. So that tells me this is the telling week. Either we're going to embed or not. Now, if the market rallies further, and you do have an outside week up, the resistance is 23,800 to 23,231, the 200-week average. You're not in a trend. You have a higher high, lower low, outside week up. If you take out this week's low, it could happen any point during the week. That would be a failure, a trap for the bulls, and I think you'd be down. Wherever that Bollinger Band comes in, it'll go up a little bit next week, just the nature of how the formula is going to work, because you had an up week of size this time. You had an 8% gain in the market. In Brent versus WTI crude, the market seems to have found a home at a $6 difference. If you look at crude, void of a trend. This market keeps hitting the Bollinger Band, trying to get rallies that don't go anywhere. They're capped at the 18-day average since you've hit the lower band, and virtually impossible to trade. I don't see a trade set up here at all, and you don't have embedded ratings. What about in WTI? Is this getting more bearish? Both numbers are under 14. Both were under 14 the week before, and both were under 14 the week before and the week before. Not the week before. So you got 4 weeks in a row of it. You're embedded. What does that tell me? It tells me that on attempts at rallies, the pros are going to sell on a weekly basis, and they will cover if the red line closes over 21. If you close over 21, it is the first sign the prices are going to go back into that $100 range. Until that occurs, the pros will bet that it's not going to do that yet. So I know so many firms are saying bullish, 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 and they'll keep looking for the markets. Goldman's still at a 125 price. Many other firms are in the $100 plus. That would be my indicator that they're on to something. In gasoline, I think enough's enough. I think you're down to the 100-day average in the Bollinger Band. You got there last week. This week you're a little bit lower. You're not embedded. Let somebody else want to own it. 87 days in a row of lower prices. Okay. Do you think we got gouged July 4th when I was telling you this there? It seems like it was so long ago. I kept telling you what was going to happen, and it did. So it's an interesting time in the markets. What do you do with those? Well, you want to keep up with them because this is going to be a real crazy week. I promise you. It's the first full week since what I call summer has ended. And I know that's not according to Mother Nature and everything else, but it is in the trading community. People are back. They're trading. You want to keep up with option strategies, spread strategies, what the cash markets are doing. You want the whole part of it. We're commodity people writing for the futures and commodity people. And we cover all these markets throughout the whole day with multiple stories and oral commentary. How do you get all this? It's so simple. We want to put it in for you. My traders, everybody that's a paid subscriber with me and a commodity account, either one, they get all that they want of this. I'd like to show it to you free for the next week or so. How do you get it? It's pretty simple. Just go to our website under free offers. It's all there. That's all you need to do. Free offers, just give it a click or follow my finger right up here. And where do you go? That'll take you. I could use this one too, right on the head there. A cursor will appear, a little icon, give it a click and away you go. I'm Ira Epstein. You have yourselves a great weekend. I'll see you all come Monday.